I went down, 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 and the flames went higher. That seems like what's happening right now with the market. At least my little portfolio of a little this and a little that.
Yeah.
What are you dealing with coaching your clients through this third quarter?
Yeah, well, I'm glad you're still smiling, Matt. It's important for all of us to still smile. You know, I've got some numbers we're going to go through, but we've had this conversation before. And when a client calls and they're worried about the market, which is fine, it's happened. It's happened lately, not a lot, because I think that we do a good job of trying to educate our clients and teach them that markets kind of go up and down. But my ask to my client is what's changed? And you've heard me ask that question before. And that's just the last 25 years, that's the question. Like, what's changed in your life other than the markets going down? Because if you have your investments properly aligned with your goals, some of it's going to go down. That's just the natural part of life. And so I try to bring people back to their situation and how the negative 20% on their statement affects them today. And a lot of those clients have other places where they're taking money from that haven't been down or down very little that they're supplying their income with. Let's say they're in income for retirement. If you're not in retirement and the market's going down and you're adding money to your accounts, it's a really good time to do so.
Yeah, everything's on sale.
Yeah, prices have gone down and they're able to pick up more shares every time they invest in their 401k or retirement plan or whatever they do. But, you know, perspective's always a good thing too. But, you know, the reality is we're at like 40-year highs in inflation right now. The Fed completely got this wrong to begin with, in my mind, as they talked about transitory, and transitory. And the guys in the office will tell you that we had some discussions with some economists last year as I challenged them on this whole transitory thing. And now they've all come around like, oh yeah, you know, inflation's real. The whole thing of don't fight the Fed, that's a statement that's been out there for years. It's true. We can't fight the Fed. The Fed's going to continue to raise interest rates until they feel that they've got this thing under control. We could argue back and forth, and economists do all day long, on whether the Fed is going too far or they're going to hit the pause button and those type of things. And so we can't control that. Name me an economist that got the dot-com bubble right, got the '08 market, you know, housing crisis right, that got COVID right. I mean, they just don't know. And so, you know, they're looking at pieces of data and trying to put it together to give you an opinion. And we look at that all the time too. We listen to 2 or 3 economists that we trust, that we think will tell us the right things, even if we don't want to hear them, and try to form our opinion because we need to have an opinion for our clients. But at the end of this, behavior matters more than anything. Mm-hmm. Charts, graphs, I could throw numbers at you all day long. It's your behavior. And so I'll point back to clients of this. October 31st, 1994, that's when I started in this business, you know, 27 years ago. The Dow was at 3,908. The Dow right now is down over almost 20%. It's at 29,000. It was at 3,908. It's at 29,000 25 years later. The S&P was at 472 for the index. It's now at 3,500. So things go up and down. There's a lot of stuff that's happened in the last 25 years with the market, but it's higher today. And so what history has said is that the market will always hit a new all-time high. The problem is we don't know when. And so our job is to help our clients, help them behave correctly. Sir John Templeton said years ago, the 4 most dangerous words in investing is it's different this time. And that holds true today too. It's not different. We've had, back in the 70s, we had bonds that were down double digits, and we've had stocks down double digits. But it's been the 70s. And so a lot of young investors, probably you included, haven't felt where you've all of a sudden are in this safe bond portfolio that's down 10% or 15%. You're saying, what is going on?
Yeah, what's going on with these bonds and how can it be down that low?
Yeah, and you add that to the stocks being down 20%. So, you know, at the September 30th, the end of the third quarter, the lowest we've had this year. It bounced since then. We're up since then, but it was the lowest level that we had. And so the Dow's down 19%, which is 30 large company U.S. stocks. 500 large stocks called the S&P 500 down 23.87% for the year. But bonds are down 14.61, the Barclays Aggregate Bond Index. So bonds down 14, stocks down 20. it's ugly. Then if you're in crypto because you think that that's the right thing to do, that's way off. It's at 20,000 for Bitcoin. So it's like, where do you hide? The positive side is you're starting to have banks now that are starting to pay CDs, and interest rates are 2, 3, 4%. But that's not keeping up with inflation either. And do you sell something down 20% to buy something that's only going to go up 3% that's guaranteed? That doesn't necessarily make sense. So I go back to behavior with our clients, and we say, listen, where are you at today? What's changed? Nothing's changed. You're still employed. Your family's good. Your health's good. So what's changed there? And then secondly, do we have your money aligned with your goals? If you're going to take income over the next 2 years, is that money safe? Because it should be. Mm-hmm. If it's income 5 years from now, we should probably be a little bit more aggressive or ride this market out and let things go. And so I think it's just trying to be that voice of reason.
It's hard in a time like this. Like even, sitting with you all of the time, and then you look at it and you're like, man, this is brutal right now.
Right.
Maybe real estate is another thing that you should play with that idea. But the muscle of consistently investing is really the answer to it.
Yeah. We had clients, that put money in the first quarter because it was they said the market was down, it was time to buy more shares.
Yeah.
Then the second quarter, it's down lower. Then the third quarter, it's down just a touch lower. And so it's like, do you still have some powder left to invest and put back into the market? But dollar cost averaging is the number one way to invest, bar none. So,
That's
401ks, and that's the muscle of just being repeat. We go from euphoria. In 2021, most of our business clients we work with had their best year ever. Like, I don't know if I can name one that didn't. And then we go to 2022, those business clients are still healthy. They're doing well.
Yeah.
But their portfolio isn't.
Yeah.
And the portfolio is always 9 months ahead or so of the economy. So if there is a recession coming, we might not be there yet. But if it is coming, and we don't know, again, people will tell you they know, but we don't know. But if it's coming, I think this damage is being done right now. I really think that we're closer to a bottom than we were a top. And so I think people just need to take a breath. Sometimes you got to turn your head sideways when that statement comes because it's ugly.
The TV.
Turn off the TV and the news like I did a year ago. That's helpful too. But bottom line is, when you work with a financial professional, if you can get them on the phone or in Zoom or in person and have a conversation about your personal account and your goals and what's changed in your life, that's where it matters.
That's where there's a lot of value.
Yeah,
and
for sure.
Then when you sit down with people, that's where you can kind of help with keeping it in perspective.
That's right. Yeah.
Cool.
Yeah.
Anything else we should know about this for the third quarter?
No, just keep your chin up, smile. I like that. Let's keep moving on and stay healthy. So.
All right. We'll see you back here next time.
All right. Thank you.